how bad do economic shocks have to be for the BOT to cut rates further, given that rates are already at record low?
The policy rate is already quite low, it's historic low. And if you look at the liquidity out there from the macro perspective, there's ample, we believe that is ample liquidity in the Thai financial markets. The challenge now for us, as I mentioned, is moving away from illiquidity problems to insolvency problems, and we need a combinations of policy tools from monetary policies, financial policies, financial institutions policies to make sure that we can address the insolvency problems.
So fair to say that for the year, the BOT is done with rate cutting?
No, we keep all policy tools on the table by lowering the policy rate alone. With the transmission mechanisms not working as in normal time because the credit cost has come up substantially, it won't pass through to those that are in need of financial assistance. By looking at some forms of balance sheet policies like the soft loans that we have introduced, we provide cheap funding at a very low rate to the banks, and so that the banks can on-lend to the SMEs. Those types of balance sheet, central bank balance sheet policies can be more direct, can be more targeted, and I think more appropriate for the current situations.
But it's since given up some of its gains, minus 4.5% versus the USD year to date, among the worst performers in Asia. Does the baht reflect fundamentals now?
I think it's moving better in line with the developments of the economy.
So having said that, to that vein, are you expecting broad dollar weakness to persist?
It seems to be that way, but but even the US dollar can be highly volatile as well. You look at the size of global liquidity out there. The US dollar can be moved by a particular incident or particular news that might change the risk appetite of global investors. So we can't be complacent of the two-way movements of the US dollar.
Governor, Thailand's GDP is set for an 8 to 10% contraction this year, deepest GDP fall since 1998. And key to that rebound is a tourism sector, which is at risk of a meltdown. What is the downside risk to the projection of the BOT?
You have rightly pointed out, Haslinda, that the tourism sector is a key jigsaw in our projection. We do review our forecast on a quarterly basis, and a new forecast will come out towards the end of this month when we have the monetary policy committee meeting. But that assumptions on the tourism sector plays a very important role in our GDP forecast.
There is an increasing call for the government to do more, but public debt to GDP ratio close to the 60% limit, which means the government will find it hard to spend more at a time when it needs to spend more. How do you see the government managing this dilemma?
My personal view is that the 60% public debt to GDP limit can be relaxed. It is the limit that was set up during the normal time. And if you look at 60% of public debt to GDP, it's not high by international standard, and it's not high as compared to other emerging markets in the region. The challenge is to identify right fiscal stimulus measures. If the government can focus on the segments, particularly those related to creating employment for particular segments of the people that have been badly affected by the current crisis. I think that is more important than the debt ceiling limit.